And it's not looking too sunny in the global economy either. Countries around the world are moving in lockstep together, but they're going in the wrong direction. Let's take a look at some of the bad news. We've got in China, the manufacturing index has shown its 7th straight drop. The IMF is saying that 2012 global growth will be slower than 2011, and world stock markets are down 9% since mid-March. Not very good. For more on what's happening on the U.S. side of this, let's go to Washington, to the WSJ's Fed Supremo, John Hilsenrath. Dr. Hilsenrath, give us the latest prognosis.
Yeah, I'm here. I'm the bearer of not very good news today, I guess. Yeah, so the prognosis is that we've seen a global economy that's tended to move in sync in the last several years. It went into recession in sync in 2008. Came out in sync after that. What looks like might be happening right now is a slowdown on a global basis, not driven by the United States, which is what happened in 2008, but driven by Europe and actually China, which is one of the surprises here because China had been driving global growth before. But they're seeing a real stumble in their growth outlook right now.
John, the latest U.S. economic data, as you say, the U.S. is a bright spot, but the latest data we got yesterday, the durable goods orders, wasn't that great.
No, and so what we see right now is a little bit of a stumble in our manufacturing sector, which is important for a couple of reasons. One is that's been one of the bright spots before. The other is that's one of the sectors in the economy that's most linked to the rest of the world. And that's where we're seeing problems not just in Europe and China, but also in South Africa, Brazil, India. We span the globe in our story today, and we're seeing signs of slowdowns all over the place there. It might be temporary. I think a lot of people are hoping it's temporary, but it has the potential to feed on itself as a synchronized global economy does.
The one bright spot in this, John, and I don't know if you're heading off anywhere this weekend, if you're coming back up here to New York or just putting the kids in the cars down to Virginia Beach, but over the past month we've seen oil prices come down by about 15%, which means gas prices coming down. How much of a boost is that actually to the consumer?
David, I'm going to be riding my bicycle around this weekend. I'm staying in the neighborhood.
You are so eco-friendly, John.
So I'm not going to be helping anybody there. That is a help for American consumers when oil prices fall. It's a two-sided story. The fact that oil prices are falling tells us that the global economy is slowing. Oil prices are an important indicator of global growth prospects. When the global economy is strengthened, oil prices have gone up. But it is a transfer to the U.S. because we've been large net importers of oil in the past. That's actually changing now. That's a little bit of a boon to American consumers this summer, and they could use the help, frankly.
Now, John, you also mentioned China slowing, which, as you say, China was sort of the engine there.
That's a big part of the story.
Right, very important. How likely is it, though, that the Chinese government, which we're seeing a changeover in the Chinese government also, that a new Chinese government is just going to stand back and say, oh, we'll just let the economy slow down? Well,
they're not going to like this when I say this over at the Federal Reserve, but in some ways the Chinese government is like the Federal Reserve in that in that they've demonstrated in the last few years that they don't put up with growth slowdowns lightly. That when things slow down, they attack it very aggressively. The question is whether the Chinese are running out of some ammunition. A lot of economists will tell you they have plenty of leeway to amp up growth, but the fact is they pumped a lot into their system after the 2008 slowdown, and some people think it caused a housing bubble. Can they afford to do much more, without creating some new piece of excess in their own economy, in the housing market, property market, or somewhere else?
Okay. Well, John, you know what? Very interesting, but I think now that you've compared Ben Bernanke to Chairman Mao, we're going to let you go get on your bike, all right? Have a great weekend,
I better get
John.
out of here.
Thank you.